Step 4, securing the proper protection that you need. How much life insurance do you need to protect the ones you love? The good news is that there's a simple way to figure it out. What's one of the biggest reasons to get life insurance? It's to protect the ones you love. The truth is, life insurance is an important component of a sound financial strategy. If you have too little, your family may not be able to live a reasonable standard of living if you were to pass away unexpectedly. If you have too much, you could be sacrificing something that you may also need. You want to right-size your coverage. Use the cash you have to reduce any debt, build an emergency fund, or prepare for a better future. Here's an easy way to calculate how much insurance you may need. We call it the DIME method. That's D-I-M-E. Here's how it works. The D stands for debt, I for income, M for mortgage, E for education. So essentially, you want to total up your debts, you want to add in your income, the amount of your mortgage, and any educational expenses that you plan to have in the future, and then subtract that minus any insurance you currently have in place. If you have a shortfall or a surplus, that lets you know if you have enough insurance or if you don't have enough. Now, if you have a young family, the income would typically be 10 times your annual income. So let's say you make $50,000 a year. If you were to pass away prematurely, you'd want to make sure that they're okay for the next decade while you're not there to provide that income. So you'd multiply your income of 50 grand times 10 to get $500,000. Again, when it comes to life insurance, a basic rule of thumb is to have approximately 10 times your annual family income. That way you can get it right. You know, that simple calculation doesn't capture any variables that can really determine more of your life insurance needs. Here's another approach, just to make it super simple. Think about your family's future and assign a dollar amount to each of these items. Let's talk about any long-term and short-term debts that you may have. So a long-term debt is something, of course, like a mortgage, but a short-term debt is like credit card debt. Long-term goals are projected costs of your children's education and things like that. The insured's annual income times the number of years that it will be needed. Again, if you're trying to prepare for a family for, let's say, 10 years after your passing, then you would multiply your annual income times 10 years. However, if your children are already out of the house or you don't plan on having any children, then maybe 1 year is just enough. It all depends on who you're trying to provide for. Or if you're trying to leave it to a charity. Also very important. And then finally, you want to add in the amount you want to set aside for any funeral costs and emergency funds. Some people might not realize, but the cost of a funeral is more than $20,000 as of 2019. So there's a lot, and then even above just the cost of the burial and the actual funeral, there are a lot of costs that could be incurred by your loved ones surrounding that event. Let's say they don't live in the same city as you, they may have to fly in, they may have to put their children in child care or make other arrangements just so they can be there to attend to you in your time of need. You want to add up all the numbers from above and then thinking about any existing assets that you have. These are items like savings, real estate, and subtract those from those costs. The number you get provides a better starting point about your actual life insurance needs. Because the truth is, your family may have access to any savings, but liquidity is of utmost importance. Your next step really is to meet with an experienced life insurance professional. That way you can get a thorough evaluation of your needs and get guidance to the amount of and type of insurance that's appropriate for you. Again, both John and I have insurance licenses and are active agents and will be more than happy to sit down with you and discuss your situation should you be interested. Hey, this one's for the up-and-comers. Trending now, life insurance. Hey millennials, I'm one of them. You're young and you're healthy. You should really consider purchasing life insurance now. Here's why. People who are young and healthy have good family health history are likely to receive some of the lowest rates on life insurance. It's really best to get it while you're young because that's when you're the most insurable. So why not just purchase it now? Life insurance can help you too, It's not just about the legacy that you're leaving for others. It can provide financial support for loved ones who depend on you now. But in addition to that, it can create a strong financial foundation for your future and protect the family that you may have in the future, even if you don't have a family now. Again, talk to me to learn more about the value of life insurance, not just after you pass, but today as well. But before you buy life insurance, you really got to make a couple of decisions. Your lifestyle and financial situation will determine the kind of life insurance that you need. You may have heard of term or perm, so term insurance versus permanent insurance. Do you know the difference? Term insurance is life insurance that provides coverage for a specific period of time, or a term, like 10 or 20 years, sometimes more. It can be renewed when the term is over. However, it's usually at a higher rate, and it does not build any cash value. It's really a use it or lose it type of purchase. And let's be honest, we don't actually want to use it. Permanent insurance, on the other hand, offers lifetime financial protection as long as the premiums are paid. And that lasts up until the death of the insured. So that means as long as you keep paying your premiums, then your life insurance will be in place no matter how long you live. So it's a little bit of a safeguard there. In the meantime, the policyholder can access something called cash value if they need it. And they can actually loan against that cash value in the form of loans. And they're just simply subtracted from the death benefit when those loans are paid. So think of cash value like a little savings account that builds up in the life insurance policy. It's pretty awesome. There are several types of permanent life insurance. They are indexed universal life, whole life, and universal life. They each differ in the premium levels, how much the premium is, if the premium amount is level every year, or if it's variable, meaning you can pay different amounts depending on your income for different years, as well as how the cash value accumulates. Again, that's that kind of savings account portion. So they each perform differently, and it really depends on your own situation and what it is you're trying to do. If you're interested, give me a shout, and we can find out what's the best type of life insurance that's for you.